Welcome to Smart Tech and Finance. Today we will explore the top 3 artificial intelligence stocks for the next decade. The artificial intelligence revolution is just beginning. Beyond the massive gains of Nvidia, incredible hidden opportunities await forward-thinking investors. Look at these explosive growth charts. The market is constantly shifting, and finding the next major breakout requires deep analysis. We are diving deep into companies that heavily leverage machine learning but receive far less mainstream media attention right now. Our comprehensive analysis will compare crucial financial metrics like price-to-earnings ratios and overall revenue growth across different sectors. Understanding the underlying technology is absolutely essential. Data centers and advanced processors form the critical backbone of this digital revolution. Imagine holding a stock that multiplies in value over 10 years. That requires patience, vision, and a solid financial strategy. Let us begin our journey by examining the first massive player in the software ecosystem that is dominating enterprise solutions. Microsoft is not just a software giant anymore. They have strategically positioned themselves at the very center of cloud computing. Their strategic partnership with OpenAI has completely revolutionized how businesses integrate advanced generative models into their daily operational workflow systems. Azure Cloud Services continue to report double-digit growth quarter after quarter, driven largely by massive enterprise demand for compute. When we look at their balance sheet, the sheer amount of free cash flow provides incredible stability during market downturns. Copilot integration across the entire Office suite means hundreds of millions of users are now interacting directly with machine learning. This seamless integration creates a massive competitive moat that protects their market share from smaller emerging software-as-service startups. Investors often overlook how sticky these enterprise contracts truly are. Once a company adopts Azure, switching becomes incredibly costly indeed. Looking at the price-to-earnings ratio, Microsoft commands a premium valuation, but their consistent execution justifies this higher multiple. Revenue growth remains incredibly robust for a company of this massive scale, proving that their strategic acquisitions are paying off. Data centers require massive capital expenditure, and Microsoft is investing billions to ensure they maintain their critical infrastructure leadership position. These massive server farms are the literal engines of the modern digital economy, processing trillions of complex calculations every second. Security is another major growth vector. As digital threats multiply, their integrated cybersecurity solutions become absolutely indispensable for large corporations. Their gaming division also provides a unique consumer data pipeline, further feeding their massive algorithms with valuable human behavioral insights. For long-term investors, Microsoft represents a foundational portfolio holding that perfectly balances aggressive technological innovation with proven financial stability. Now, let us shift our focus to a completely different type of technology company that operates in the shadows mostly. Palantir Technologies is a deeply fascinating software enterprise that specializes in big data analytics for both government and commercial clients. Originally funded by the Central Intelligence Agency, they built their reputation by solving the most complex data problems on Earth. Their Gotham platform is currently utilized by military organizations worldwide to track threats and manage incredibly complex global logistical operations. However, the truly explosive growth narrative lies within their commercial sector expansion, specifically through their innovative Foundry software platform offering. Foundry allows massive corporations to integrate siloed data streams into a single, unified dashboard for real-time operational decision-making. Recently, Palantir launched their artificial intelligence platform, which has dramatically accelerated their customer acquisition rate across multiple diverse global industries. Hospitals use their software to optimize patient care, while manufacturing giants use it to streamline their fragile global supply chains. Financially, Palantir has recently achieved consistent profitability, which is a massive milestone that significantly reduces the overall risk for investors. Their revenue growth in the commercial sector is vastly outpacing their government contracts, proving the broad applicability of their products. When analyzing their forward price-to-earnings ratio, they appear expensive, but their unique software architecture lacks any true competitors. They operate with zero debt on their balance sheet, providing them with immense flexibility to weather any potential economic storms. The switching costs for Palantir customers are astronomically high. Once integrated, their software becomes the central nervous system of operations. This creates a highly predictable recurring revenue model that long-term shareholders absolutely love to see in a growth stock. As data complexity continues to explode exponentially, the demand for powerful analytical tools like Palantir will only continue to rise. Holding this stock requires conviction, as their unconventional management style and volatile share price can test the patience of investors. Yet for those willing to look past short-term noise, the 10-year horizon looks incredibly promising for this disruptor. Moving beyond software, we must absolutely examine the physical hardware layer that makes all of this incredible computation actually possible. While Nvidia designs the most popular graphics processing units, they do not actually manufacture the physical silicon chips themselves ever. This brings us to the crucial semiconductor fabrication companies that serve as the fundamental backbone of the entire digital revolution. Taiwan Semiconductor Manufacturing Company is the undisputed king of chip foundries, producing the most advanced silicon wafers on the planet. They manufacture chips for Apple, Nvidia, and advanced micro devices, making them an indispensable partner in the global technology ecosystem. Their technological lead in extreme ultraviolet lithography creates a massive barrier to entry that competitors simply cannot overcome right now. Financially, their operating margins are truly spectacular for a hardware manufacturer, reflecting their incredible pricing power in a constrained market. Revenue growth is directly tied to the global demand for advanced computation, which is currently experiencing an unprecedented supercycle. However, geopolitical risks do exist, making some investors slightly hesitant about committing a large portion of their portfolio to them. To mitigate this risk, we must also look at the companies creating the incredibly complex machinery used to print chips. ASML is a European technology giant holding a literal monopoly on the extreme ultraviolet lithography machines required for advanced chips. Without their highly sophisticated engineering marvels, the continued shrinking of transistors and the advancement of Moore's law would completely stop. Their backlog of orders stretches out for years, providing incredibly clear visibility into their future revenue streams and cash flows. The price-to-earnings multiple for ASML reflects this absolute dominance, but true monopolies rarely trade at a discount price. Investing in these foundational hardware companies is essentially a bet on the continued digitization of the entire modern human experience. Let us now compare these three unique investment opportunities side by side to understand their distinct roles in a portfolio. Microsoft offers the ultimate stability and steady growth, leveraging their massive enterprise footprint to slowly dominate the intelligent cloud sector. Palantir represents the aggressive growth play, offering a pure software solution that solves the most complex data integration challenges today. The semiconductor giants provide the essential physical infrastructure, acting as the ultimate picks and shovels investment during this digital gold rush. When constructing a long-term portfolio, diversification across these different layers of the technology stack is absolutely crucial for success. You do not want to be entirely exposed to just software, nor do you want to hold only physical hardware. Let us dive deeper into the specific financial metrics that separate the true long-term winners from the temporary hype. Return on invested capital is a fantastic metric to evaluate how efficiently a management team is deploying their available cash. Companies that consistently generate high returns on invested capital tend to heavily outperform the broader market over a 10-year period. Gross profit margins reveal the true pricing power of a business. High margins indicate a product that customers desperately need. We must also carefully monitor share dilution. Companies that constantly issue new stock are secretly destroying your overall shareholder value. Fortunately, the three companies we highlighted today have strong track records of managing their capital structure with incredible financial discipline. Let us look at a visual projection of how a $10,000 investment could potentially compound over a decade. Assuming a conservative 15% annualized return, your initial capital would double in roughly 5 years through the compounding effect. By year 10, that same investment could grow to over $40,000, assuming the underlying business fundamentals remain intact. This illustrates the incredible mathematical power of long-term investing. Patience is truly the ultimate advantage for the retail investor. Institutional investors are often forced to chase short-term quarterly results, missing out on massive multi-year secular growth trends. You have the distinct luxury of buying great companies and simply holding them while their fundamental business stories slowly unfold. Of course, volatility is the price of admission in the stock market. You must be mentally prepared for massive drawdowns. During market corrections, these high-growth technology stocks can easily drop 30 to 50% from their all-time highs. These violent price swings shake out the weak hands, transferring wealth from the impatient traders to the patient long-term investors. Having cash on the sidelines allows you to aggressively accumulate shares of these incredible companies when they are temporarily discounted. Let us analyze the specific macroeconomic factors that could potentially accelerate or derail this massive technological supercycle we see. Interest rates play a massive role in stock valuations. Higher rates generally compress the multiples of high-growth technology companies. However, truly exceptional companies can outgrow macroeconomic headwinds through sheer fundamental execution and aggressive market share expansion in their sectors. Inflation also impacts operational costs, but software companies typically have incredible pricing power to easily pass these costs to consumers. Global supply chain stability is absolutely critical for the semiconductor industry, making international trade relations a key metric to watch. Despite these potential risks, the overarching trend is undeniably clear. The world is becoming increasingly digital, automated, and highly connected. Artificial intelligence is not just a passing fad, it is a fundamental shift in how humanity processes and utilizes information. Just as the internet revolutionized commerce in the late 90s, machine learning will fundamentally transform every single industry on Earth. From autonomous transportation to personalized medicine, the applications for advanced computation are literally boundless and incredibly exciting for our future. By carefully selecting the right companies today, you are essentially buying a stake in the future infrastructure of human civilization. Let us review our core thesis. We are looking beyond the obvious hardware plays to find sustainable long-term value. Microsoft provides the secure enterprise cloud foundation. Palantir delivers the crucial analytical software layer, and semiconductor foundries build the engines. This diversified approach minimizes your overall portfolio risk while maximizing your exposure to the most explosive growth sectors available today. Remember that investing is an ongoing journey. You must continuously monitor your holdings and verify that the original thesis holds. Quarterly earnings reports provide vital clues about the fundamental health of the business and the overall trajectory of their industry. Pay close attention to management commentary regarding future guidance, as the market is always looking 6 to 12 months ahead. Do not get distracted by daily price fluctuations. Focus entirely on the underlying business metrics and their long-term strategy. Are they growing revenue? Are their profit margins expanding? Are they successfully retaining their most valuable enterprise software customers today? If the answers to these crucial questions remain positive, then temporary stock price weakness is simply a massive buying opportunity. Let us take a moment to visualize the massive data centers that are currently being constructed all around the globe. These monolithic structures consume enormous amounts of electricity, requiring massive investments in green energy infrastructure to remain environmentally sustainable for decades. This creates yet another incredible investment vector, but we will save the renewable energy discussion for a future detailed episode. The interconnected nature of the global economy means that a breakthrough in one sector rapidly accelerates innovation in another sector. Better chips lead to smarter software, which in turn helps engineers design even more incredibly advanced physical silicon processing architectures. This beautiful, virtuous cycle of innovation is the exact reason why technology stocks have historically dominated the broad market returns. We are currently standing at the precipice of a brand new era of unprecedented human productivity and massive economic expansion. Positioning your portfolio correctly right now could potentially generate generational wealth for you and your family over the coming decades. It requires diligent research, unwavering emotional discipline,